Do you want to generate consistent income from selling options? Let's dive into one of the most popular and beginner-friendly strategies out there, the covered call. In this video, I'll break it down step by step, show you how it works, and I'll also share 3 to 4 alternative strategies that make it possible for all accounts of all sizes to join in on the fun. Stick around, I promise you'll learn something new. I do consider covered calls the gateway strategy into the world of option selling. So if you haven't sold one or traded options before, make sure that you have it enabled in your settings. It's quick and easy, and I'll link a video here. You will need to have at least level 1 access for selling covered calls and level 3 access for the alternative strategies I'll discuss later on. So what is a covered call? A covered call is like placing a limit sell order on a stock that you already own. You get to set the price that you're willing to sell the shares at, and you even get to decide how long that order will stay active, whether that's just for the day or up to several months. If the stock hits your target price, your shares are sold at that price. Now here's where it gets interesting. Instead of just waiting for the stock to reach your limit price, you can actually use call options to achieve the same thing, but with one major advantage. By selling a call option, you actually get paid up front to set that limit sell order. Let's walk through an example. Here on Intel, I own at least 100 shares, so I can sell a covered call. First, I'll open up the option chain and decide how long I want this order to stay active. This is called the expiration date. It's entirely up to you, but I typically choose dates within the next 30 days. Let's pick January 31st as an example. Since we are selling a covered call, we need to make sure that we are on the sell and call tabs. On the left side of the option chain, you will see various prices listed. These are called strike prices. The strike price represents the price at which you're agreeing to sell your shares if the stock reaches or exceeds that level. On the right side, you'll see something called premium. This is the amount you'll get paid for agreeing to sell your stock at the corresponding strike price. The premium is quoted on a per share basis, and because each option contract represents 100 shares, you multiply that premium by 100 to find your total payout. For the example of the 22.5 strike call, the premium is 43 cents per share. If we multiply that by 100 shares, we will receive $43. Luckily, you don't have to do this math every time. Platforms like Robinhood automatically calculate the total for you. So when you select the strike price and review the order, you'll see the estimated credit listed. In this case, $43 minus any fees. Here's one quick tip. The word credit means this is the money you'll receive. If you see the word debit instead, that means you're paying money, which is not part of this strategy. If that happens, double check that you're on the sell tab. Now we can fine tune the limit price if we want to try to get a little bit more money up front, but please note that someone has to agree to buy it from you. So if you go too high above the ask price, you might not get filled. For this example, I'll keep it at 43. Now let's take a closer look at how this plays out. By clicking on the arrow here, we can view the profit loss chart. This chart shows how much the option will be worth based on the stock price at expiration. Now, what happens if Intel stays below 22.5 by the expiration date? The option will expire worthless. In this case, we keep both our shares and the $43 of premium we collected from selling the option. On the other hand, if Intel trades above 22.5, we will likely be assigned, meaning we will sell our 100 shares at 22.5 per share, regardless of how high the stock price goes. That's okay though, because by entering this contract, we agreed to sell at that price. We will happily sell our shares, lock in a profit based on the difference between 22.5 and our cost basis of our shares, and we still keep the $43 premium as additional income. Now you might notice that the P&L chart says the max loss is unlimited. This can be misleading because technically selling a naked call does have unlimited risk, but we're not selling a naked call here. We're selling a covered call. Because we already own the shares, there's no realized loss on the upside, just a missed opportunity if the stock skyrockets past our strike price. The only time you'd experience a loss with this option contract is if you chose to buy to close the call option to avoid being assigned, which would lock in a loss on the premium option itself, but in our case, we aren't looking to do that. Now that we've sold the call option, let's talk about managing it. In my portfolio, I currently have 3 active covered calls, but for consistency, let's stick with our Intel example. And maybe you noticed before, but I actually sold the 22.5 strike call before recording this video. So pulling up in this position, we can see some details. I originally sold this contract for $53 in premium. And just as a side note, this option happens to be expiring after earnings, which inflated the premium slightly compared to normal. But since this is a covered call, meaning we are short the call contract, our goal is for this value to decrease over time to $0, actually allowing us to maximize profit. And as of now, I'm already up roughly $10. And as long as Intel stays below my strike price of $22.5 through expiration, my return will continue moving towards 100%, meeting that total profit of $53. But of course, the stock market is unpredictable. So let's talk about how we can manage this position depending on how things play out. The first management strategy is also the simplest. Do nothing. If the stock price stays below our strike price, we can simply let the contract expire worthless. This means we keep the $53 of premium and also retain our 100 shares. Once the option expires, we can just rinse and repeat, selling another call in the future to continue to generate additional income. However, if the stock price rises above the strike price, the call option will likely get assigned. This means that we sell our 100 shares at the agreed upon strike price, but the good news is we still get to keep the $53 of premium and any profits from selling the shares above our cost basis. These are the two hands-off approaches and require minimal intervention on your part. Now, the other two management strategies require a bit more attention. The first is to actually buy to close the position, which means exit the option position entirely. This can be done whether you're winning or losing on the trade, depending on your goals. When you buy to close, you're looking to lock in any gains or losses, and you're ensuring that the future stock movements won't impact the value of your option anymore. For example, if the stock price happened to be climbing quickly and you want to avoid assignment, you might close for a loss. On the flip side, if the stock prices stay below your strike, you could close for a profit, securing the premium you've earned so far. Buying to close is a solid management strategy when you're wanting to protect gains, limit risk, or reposition yourself for a new opportunity in the market. For an example with my current position, if I decided to buy to close this, I would be locking in the $10 of profit that I've gained thus far. Now, the last and most flexible option is to actually roll the covered call. Rolling involves closing your current position and simultaneously opening a new one, typically with a later expiration date and or maybe a different strike price. Why would you roll? Well, there are several reasons. Most commonly, it's to avoid assignment and give the trade more time to play out. Another reason might be just to move to a higher strike price and capture more upside potential while you're still collecting that premium. And lastly, you might just want to roll to extend the trade for another cycle while locking in some gains. Although you can technically roll any position, most traders aim to roll for a net credit, meaning a profit. I'll link a video explaining rolling in detail, but I could quickly show you how it's done, as it's one of the most common management strategies for covered calls. And although Robinhood offers this nice built-in roll feature, I'm going to actually show you how to do a more custom way that'll apply to different strategies, because this approach gives you more flexibility and is useful because the roll feature isn't always accessible for every strategy. So let's back out of here and return to the standard option chain. In order to properly roll a position, we need to ensure that we're closing it in the right way. Since we originally sold to open the covered call, we need to now buy to close that position. To do this, we'll switch over to the buy and call tabs and select the same strike that shows the -1 in your portfolio. In this case, that's the 22.5 strike. Once we selected that, we can move on to opening a new position with a later date. So let's go an extra week out and choose the February 7th expiration date. Now that we have that selected, we want to make sure we go back to the sell and call tabs and ensure that we're selling a new call that will exceed the cost of closing the current position. In this case, we were paying $43 to close our current call, so we want to sell a new call with a premium higher than $43. This will ensure that we're rolling for a net credit, meaning we were still making money on this adjustment. In this case, we can just select the same strike of 22.5 because that exceeds that value. And going to the order form, it'll do the math for us, and we can see that by rolling this position, it will result in an additional credit of $25, while also adding an additional week of time. So that's the basics of opening, managing, and closing your covered call positions. And if that felt like a lot, take a breather and feel free to rewatch any part of this video to solidify what we've covered so far. But as promised, we're not stopping here. Again, this is the only video you'll need on covered calls. Up next, I'll be walking you through 3 to 4 alternative strategies to the standard covered call. While they might require a bit more attention, they could ultimately align better with your goals or account size. In the meantime, don't forget to drop a like, let me know in the comments if this breakdown has been helpful, and consider subscribing. It's completely free and supports the channel in a big way. And getting back into it, why is there a need for alternative strategies? Well, the main reason is you need to have 100 shares of the stock to sell a covered call. And for those high flying stocks like Nvidia, Tesla, Apple, Google, you could be paying anywhere from $10,000 to $30,000 for 100 shares. And that makes it really tough for smaller accounts to use this strategy. But don't worry, there are alternatives that will give you the same income generating benefits without the requirement of so much capital. And for the first one, let's use AMD as an example. This strategy is called the poor man's covered call, and you may have already heard of it. It's a very popular alternative to the standard covered call. And it gets its name because instead of needing to own 100 shares of the underlying stock, which for something like AMD would cost around $11,500, we can simulate owning those shares by purchasing a leap option instead. This leap option will act as collateral in place of those physical shares, making this strategy much more accessible for smaller accounts. Let me show you exactly how to set it up. We start by selecting a leap option, which is simply a long-term expiration option. Let's go about a year out at the January 16th, 2026 expiration date. Since we're simulating stock ownership, we'll focus on buying a call option, so make sure you're on the buy and call tabs. When choosing this call option, there are a few extra considerations to keep in mind, primarily the value of delta. Delta represents how much the option's price changes relative to the stock price. So we want an option that behaves similar to the stock itself. This means we want to look for a high delta option, ideally one that's deep in the money. For example, we can see here that the 100 strike call has a delta of around 0.73, which is perfect. The cost of this option is roughly $3,000. Now, I know you might be thinking $3,000, that's still a lot of money, but here's the key. By purchasing this leap option instead of 100 shares, you're actually saving 73% compared to buying the stock outright. This significant cost reduction is what makes the poor man's covered call such a great strategy for smaller accounts. Now, there are a couple different ways to approach this strategy. You can simply just hold on to the leap and wait for an opportune time to sell a covered call against it, or you can just sell a call immediately after buying the leap. With this strategy, you'll likely end up selling multiple covered calls over the course of the leap's lifespan. On Robinhood, doing this in two separate orders will look more similar to setting up a standard covered call. But for the sake of clarity, I'll show you how to set it up all at once so we can see what the P&L chart looks like for the first expiration. So let's back out of here and select a call to sell against this leap. So let's move up to the weekly expirations and select the January 31st. We want to make sure that we switch over to the sell and call tabs. Now, we'll approach this the same way we did with standard cover calls. We want to pick an out of the money option, a call option that will be comfortable selling our stock, or in this case, our leap option. Scrolling through, let's take a look at the 120 strike. This 120 strike call would pay roughly $110, $115 in premium, which if we owned 100 shares would translate to just under a 1% return. But in this case, since we're only paying $3,000 for the leap option, it's actually closer to a 4% return, a significant boost for smaller accounts. But here's something else to consider. Just like with the stock, we can realize profit on the leap option itself during an upward movement in price. In fact, our maximum profit would be if the stock price would go exactly to the covered call strike price. In this example, that would result in a total profit of $440. Pretty good, right? And if the stock were to hit that covered call strike price of 120, we could just simply close the entire position to lock in that profit. Even if the stock climbs above our strike price, it would need to go all the way to $144 before we would experience any loss on the upside due to the leap option's intrinsic value. And that's the poor man's covered call. But before we wrap it up, I also wanted to show you what this looks like when the trades aren't entered at the same time. So let's go over to my account overview and check out active poor man's covered call positions on NVIDIA. Here with my NVIDIA positions, you can see that the leap option is the 108 strike call, and the cover call I sold is the 144 strike. This is during trading hours, and as you can see, NVIDIA has actually been getting slammed recently. But that's okay, my covered call is profiting from that drop, and I still have plenty of time on my side with the leap to recover, just like I would if I would own the stock outright. If we take a closer look at the covered call I sold, you can see that I sold this past Friday for $372, and I'm already up 95% on that position. This gives me a lot of flexibility. If I wanted to, I could close it early to lock in those gains, or I could even roll it out and maybe down, just like I would with any other covered call. So that's how the poor man's covered call will look like for most of its life cycle, balancing the leap option and the short-term call positions while taking advantage of time and flexibility. Now let's transition into the next alternative strategy, diagonal spreads. And we'll continue to use AMD as our example. And before anyone calls me out in the comments, yes, technically the poor man's covered call is a type of diagonal spread. By definition, a diagonal spread is when you buy and sell calls or puts with different strikes and different expiration dates. However, the poor man's covered call focuses specifically on buying a deep in the money call with significant time until expiration, making it behave like owning the stock. But with diagonals, you don't necessarily need that deep in the money call or a leap to profit. Instead, you can look at buying a call option within 4 to 5 months until expiration, and while it can be deep in the money, it doesn't have to be. For this example, let's set up a diagonal spread using AMD with an expiration date around May. Like with the poor man's covered call, we start by buying the long option. So let's switch over to the proper tabs and look at the same strike as before, the 100 strike call. This option is already about $1,000 cheaper than the leap we used earlier. Why? Because it has less time until expiration, which technically does mean more risk since it won't hold its value as well over time, but it's also much cheaper, making it more accessible for smaller accounts. So let's select this option and move on to selling the covered call against it. So we'll keep the same strategy and select the January 31st and switch over to the sell tab. We could select the same 120 strike covered call as before and pull open the P&L chart to compare. Here we can see that the max profit is roughly the same, although it has significantly lower max loss and entry price. So this might be a better strategy for you. I just want to note the importance of time decay. As you get close to expiration, the time decay on the long option will start to increase significantly. Time decay is determined by theta here. This is how much the value of the contract will lose per day. And right now, being $5, it's not that big of a deal. But once you're within 45 days till expiration, it will start to eat into your profits. So you need to monitor this, just like with the poor man's covered call or any long option position. So consider adjusting or closing the full position once you're within those 45 days till expiration. For example, compare that to the theta decay on the 120 strike call. This one is losing $26 per day just because of time. So it's definitely worth your consideration. This video is becoming longer than I originally anticipated, so let's quickly wrap it up with one final alternative. And this is by far the cheapest strategy, but also the riskiest, and it's the credit call spread. So let's build one out with AMD. We start by selecting the call that we want to sell. Let's go with the 120 strike call again. Now instead, we're going to switch to the buy tab and we're going to cover this position by buying a call at a higher strike with the same expiration date, such as the 122 strike call. Now, while this setup significantly cuts into our potential profits from the covered call, it drastically reduces the collateral required. In fact, you'll only need to front the difference between the strikes. For example, with the 120-122 call spread, your max loss is just $200 with a max profit of $38. And I want to note that this strategy operates a little differently. It's usually considered a binary trade, a win or a loss. If the stock price stays below the short strike call, in this case $120, you'll walk away with the maximum profit. But if the stock climbs above the short call, you're likely going to incur a loss close to the max loss. While it's a much different approach, credit call spreads are a noteworthy alternative for smaller accounts or traders looking to minimize collateral requirements. I'll link a full video on credit spreads here for those who want a deeper dive into this strategy. And with that, I'll wrap it up. Thanks for sticking with me as we explored covered calls in detail, along with some of the cheaper alternatives like the poor man's covered call and diagonals. Each strategy comes with its own unique risks, so make sure to choose the one that best aligns with your goals and risk tolerance. And if you're ready to take things to the next level, check out this video on the wheel strategy to learn what to do once your covered call gets exercised. Happy trading, and I'll see you in the next video.